If you want to stop depending entirely on a paycheck, you have to understand the difference between earning money and owning systems that pay you. Most people spend their whole lives doing the first thing. They trade time for income. They wake up, go to work, solve problems for someone else, and receive a paycheck because they showed up. If they stop showing up, the paycheck stops. That is the basic structure of employment. It is not bad. It is not shameful. It is not something to look down on. In fact, for most people, a job is the first machine that produces income. It gives you stability, it gives you structure, it gives you capital, but it also has one very clear limitation. Your income depends on your continued labor. If you earn $80,000 a year from a job, and you want to leave that job without reducing your life, the math is not emotional, it is mechanical. You need another system that can produce roughly $80,000 a year for you. Not once, not during a lucky year, not because an asset went up on paper. You need actual income that can come in whether you are sitting at a desk, sitting at home, or not working at all. That is the difference many people miss. They are told to invest for wealth, but they are not taught to invest for income. Those are related, but they are not the same. A person can own an asset that grows in value and still not have enough cash flow to pay the bills. A person can see a brokerage account balance rise and still feel trapped by a paycheck because the portfolio is not designed to send money back to them regularly. This is why when I look at financial independence, I do not begin by asking what asset can make me rich the fastest. That question usually produces bad behavior. It creates leverage, it creates speculation, it creates the desire to jump into something without understanding the risks. The better question is much calmer. What assets can create recurring income? What are the trade-offs? How difficult are they to manage? And how much capital, skill, and patience do they require? That is the right way to think. You do not build a life of freedom by chasing a fantasy. You build it by understanding the machines that produce cash flow, then gradually owning more of those machines, and there is a sequence to it. Some income assets are simple. They are not exciting, but they are understandable. Some are more advanced because they require more judgment. Some require operating skill. Some require tax knowledge. Some require dealing with people. Some require accepting risk that will not show up until something breaks. The mistake is not choosing one over another. The mistake is thinking they are all the same. They are not. Each income asset has a different purpose. Each one sits in a different part of the system. Each one can help you replace a paycheck. But each one can also hurt you if you misunderstand what it is designed to do. So I want to walk through the 5 broad assets a person can consider if the goal is not just to build wealth on paper, but to replace earned income with investment income. And I want to begin with the simplest one because simplicity matters. The simplest income machine is lending to the government through Treasury securities. When you buy a Treasury bond or a short-term Treasury bill, what you are doing is very basic. You are lending money to the United States government, and the government pays you interest for the use of that money. There is no complicated business model. There is no tenant calling you at midnight. There is no restaurant to run. There is no CEO you have to trust to make capital allocation decisions. You lend. They pay interest. That is why this is often one of the first places people look when they want to create income. The attraction is clear. The credit risk is generally viewed as very low because the borrower is the United States government. If that borrower fails in a serious way, the problem is not just your Treasury investment. The problem is the whole global financial system. That does not mean there is no risk. It means the nature of the risk is different. There is also a tax feature that matters. Interest from Treasuries is generally not subject to state income tax. That can make the after-tax income more attractive than money sitting in a bank account or a high-yield savings account, depending on the person in the state, and Treasuries can create regular income. A person can use Treasury securities directly, or they can use a Treasury bond ETF that holds short-term government obligations. Some of these funds are designed to pay monthly income. In the original example, SCUV was used because it holds very short-term Treasury bonds with maturities of 3 months or less, and at that time it was paying an annual yield around 4.7%. That is not a promise about future returns. Interest rates change, the Federal Reserve changes policy, yields rise and fall, but the structure is what matters. This kind of asset can give you income, but it does not give you growth of principal in the way a business or a stock can. If you lend $100, the $100 does not become $200 because the underlying enterprise expands. You receive interest on the $100. That is the trade-off: stability on one side, limited upside on the other. Many people fail because they want every asset to do everything. They want safety, high income growth, liquidity, low taxes, and no volatility. That asset does not exist. Every asset has a set of trade-offs. The mature investor does not ask, how do I eliminate trade-offs? The mature investor asks, which trade-offs am I accepting and why? Treasuries are useful because they can be simple, liquid, and income producing. They are not designed to make you rich quickly. They are not designed to compound your purchasing power like an outstanding business might over decades. They are designed to turn capital into interest with relatively low credit risk. If your goal is to replace a paycheck, this can be one part of the system. But it is usually not enough by itself unless you have a very large amount of capital. This is where people begin to feel the hard math. If an asset pays roughly 5% and you need $80,000 of income, then you need a lot of capital to produce that income. That is not discouraging. That is reality. And reality is better than fantasy because reality tells you the truth before you make a bad decision. The next layer is dividend. Paying ETFs. This is where you begin to move from lending to owning when you buy a dividend. Paying stock, you own a small piece of a business. If that business earns profits and chooses to distribute part of those profits to shareholders, you receive a dividend. That is the basic mechanism. A company like McDonald's, for example, can make billions of dollars in profit. It can reinvest some of that profit, reduce debt, buy back shares, or distribute some of that profit to owners. If you own shares, you own a claim on that distribution. This can be powerful because good businesses can raise dividends over time. But there is also a risk that many people underestimate. A single company can make mistakes. It can take on too much debt. It can hire poor leadership. It can lose customers. It can cut the dividend in extreme cases. It can go bankrupt. Then you do not just lose the income, you can lose the capital too. This is why dividend paying ETFs can be useful for people who want income but do not want to analyze each company deeply. An ETF is a basket. Instead of depending on one company, you own a collection of companies selected around a strategy. If one company weakens, the fund can reduce or remove it over time. You are still exposed to market risk, but you are not betting your income stream on a single business behaving perfectly forever. That is an important distinction. One category is dividend aristocrat-style ETFs. These are funds that focus on companies with long histories of paying and increasing dividends. The example in the source was Noble, which focuses on S&P 500 dividend aristocrats. These are companies that have paid and increased their dividends for many years, often 25 years or more. That history does not guarantee the future. Nothing does. But it tells you something about the behavior of those businesses. It tells you they have historically had enough stability, discipline, and cash generation to keep rewarding shareholders through different cycles. Another example is a broader high-dividend ETF like SHIAG, which was described as giving exposure to high-dividend paying companies in the United States. At the time discussed in the source, it was paying around 4% in dividends. Again, the exact number is not the principle. The principle is that the ETF gives you a way to own a diversified group of income-producing businesses without having to make each individual company decision yourself. That can reduce operational burden. But it does not eliminate risk. The price of the ETF can fall, the dividend can change, the underlying companies can struggle. Interest rates can make dividend stocks more or less attractive. The economy can weaken, markets can reprice. There is no free lunch. Then there are international dividend ETFs. This adds another layer when you own international dividend. Paying companies, you are not just diversifying across businesses. You are diversifying across countries, currencies, economies, and political systems. That can be helpful because not every country moves in the same cycle as the United States. Some foreign markets can grow faster, some may offer higher dividend yields, some may be earlier in their growth path, but the additional return potential comes with additional risks. Currencies can move against you, governments can change rules, political instability can affect companies. Accounting standards and shareholder protections can differ. A high dividend yield in another country can be attractive, but it can also reflect risk that the market understands better than you do. That does not mean you avoid it. It means you approach it with humility. Examples from the source included VIMI and IDV, both international dividend ETFs. At the time of recording, the yields were described around 4% and 5% respectively. Those types of funds can be part of an income portfolio, but they require an understanding that international diversification is not magic. It is another type of trade-off. The third part of the dividend ETF conversation is real estate investment trusts, commonly called REITs. A REIT allows you to get exposure to real estate without directly buying and managing property yourself. There are REITs that own physical real estate, such as apartments, offices, hotels, and other properties. There are also mortgage REITs that invest in the loans behind real estate rather than the properties themselves. The distinction matters. A property Owning REIT and a mortgage REIT can behave very differently. One may be tied more directly to rents, occupancy, property values, and operating expenses. The other may be tied more directly to interest rates, credit spreads, mortgage markets, leverage, and financing conditions. A person who only looks at the dividend yield can get into trouble in the source. VNQ was used as an example of a broad real estate REIT ETF, and RIM was used as an example of a mortgage REIT ETF. The mortgage REIT yield looked much higher, around 9.5% at the time. But high yield is not the same as safe yield. This is one of the most important lessons in income investing. A high payout can be a gift or it can be a warning. If an asset pays a large income stream but the underlying asset value is deteriorating, you may think you are collecting income while you are actually losing capital faster than the income can replace it. That is a bad system disguised as a good one. In income investing, you must look beneath the distribution. What owns the assets? How stable is the cash flow? How much debt is involved? Can the income survive a downturn? Is the yield high because the opportunity is real or because the risk is being priced correctly by the market? These are the questions that matter. The goal is not to buy the highest yield. The goal is to buy durable income. That distinction can determine whether a portfolio gives you freedom or traps you in disappointment. Once you move beyond securities, the next income machine is direct real estate. This is more advanced because you are no longer just allocating capital. You are dealing with a physical asset, tenants, repairs, insurance, taxes, vacancies, financing, and local markets. But if you understand it, real estate can be powerful. The reason wealthy people like real estate is not mysterious. It can produce cash flow. It is a hard asset. It can be financed. It can offer tax benefits. It can appreciate over time. And in many cases, rents can rise with inflation. But those benefits only appear when the numbers work. A bad property does not become good because real estate is a good asset class. A bad deal is still a bad deal. The basic idea is simple. You buy a property not to live in, but to rent to someone else. That tenant pays rent. The rent must cover the expenses: property taxes, insurance, maintenance, management fees, vacancy reserves. And if you use debt, mortgage payments, whatever remains is your cash flow. That is the machine. But many people do not calculate the machine, honestly. They think about the rent and they ignore the leaks. They forget maintenance. They underestimate vacancy. They assume the tenant will always pay. They manage it themselves and pretend their time is free. Then the property does not produce the income they expected. This is why the numbers matter before the emotions. In the example, a person buys a 3-bedroom, 2-bath property for $200,000 and rents it for $2,000 a month. That creates $24,000 a year in potential rent. But potential rent is not profit. You must subtract expenses, property taxes, insurance, maintenance, management, vacancy. After all of that, suppose the property produces $10,000 a year in profit. If you bought the property all cash for $200,000, that is a 5% return on the cash you put in. Some people call it a cash-on-cash return. Some call it a cap rate in a simplified sense. The names matter less than the logic. You put in $200,000, you receive $10,000 a year. That is 5%. Is that good enough? It depends on your standards, your market, your alternatives, your risk tolerance, and your ability to manage the asset. In the source, the speaker wanted closer to a 7% cash-on-cash return to make the deal worthwhile. That means if $200,000 is invested, the desired annual cash income would be around $14,000. And this is where discipline enters. Many people want to own real estate, so they lower their standards until a bad deal looks acceptable. They tell themselves prices only go up. They tell themselves the rent will rise. They tell themselves they can handle repairs cheaply. They tell themselves the neighborhood will improve. Sometimes they are right. Often they are simply rationalizing. Good investing requires you to separate desire from calculation. Real estate can create income, but it is not passive in the way people imagine. Even with a property manager, you still own the consequences. If a roof fails, it is your roof. If a tenant leaves, it is your vacancy. If insurance rises, it is your expense. If local taxes go up, it is your return that gets compressed. This does not make real estate bad. It makes it real. There are also tax benefits that make real estate unique. One important concept is depreciation. The tax code generally allows you to treat a building as if it loses value over time, even if the market value of the property rises. In the example, if a $200,000 property includes $30,000 of land value and $170,000 of building value, the owner may be able to depreciate the building portion over time. That depreciation can reduce taxable income. There may also be ordinary and necessary business expenses connected to running the real estate operation. A phone used for the business, travel tied to the properties, professional fees, management costs, repairs, and other legitimate expenses can matter. But this is where a person should be careful. Tax rules are complex. They depend on facts. They depend on documentation. They depend on proper filing. The goal is not to be clever. The goal is to be correct. A good accountant can matter as much as a good property manager. The major point is that real estate can produce cash flow and tax efficiency, but it asks for work, judgment, and discipline in return. If you are unwilling to study deals, walk away from bad ones, understand local markets, factor in all costs, and build systems for management. Real estate can become a second job rather than a path to freedom. But if you are willing to do the work, it can become a serious income engine. The next asset is the one most people talk about, but few understand deeply. Owning a business. This is often the most powerful income machine because businesses can produce profits far beyond what a passive financial asset can pay. But they also require the most skill and carry some of the highest failure risk. A business is not just a stock, it is an operating system. It has customers, employees, products, cost, pricing, competition, cash flow, taxes, culture, and management problems. If the system works, it can generate income for the owner. If it does not work, it consumes cash, time, and emotional energy. The important distinction is between being an employee and being an owner. An employee is paid for work, an owner is paid from profit. Those are different streams. A person can work inside a business and receive a salary, but the salary is compensation for labor. The profit belongs to the owner after expenses are paid. That profit can be distributed, reinvested, or held inside the company. In the example from the source, imagine a business generates $1 million in revenue and has $600,000 in expenses. The remaining $400,000 is profit. That profit goes to the owner, though a company may also choose to share profits with employees depending on how it is structured. This is why ownership matters. When you own the machine, you can receive the output of the machine, but business ownership is not easy. There are two broad paths. You can start a business or you can buy one. Starting a business usually requires less capital but more uncertainty, effort, and time. Buying a business can give you an existing operation, customers, and cash flow, but it usually requires more capital and due diligence. And many small businesses are not passive. This is one of the most dangerous misunderstandings created by internet advice. People hear, buy a laundromat, buy a car wash, buy a small business, and they imagine the profits will simply arrive. But a small business often depends heavily on the owner. If you buy it and the previous owner was the main system holding it together, you may not have bought an asset, you may have bought yourself a job. That can still be worthwhile if you want the work and understand the path. But it is not passive income. If the business is small, you may need to work in it before you can work on it. You may need to operate it, improve it, hire people, install systems, and eventually remove yourself from the day-to-day role. That can take years. It can also fail. This is why I think in terms of systems. A business is valuable when it can produce reliable cash flow without depending entirely on one person's daily effort. The more the business depends on you, the less it is an asset and the more it is an occupation. The more the business has repeatable processes, good people, strong margins, durable demand, and clear controls, the more it becomes an asset. This does not mean everyone should buy a business. Many people should not. Some people do not want the stress. Some do not have the skills. Some underestimate competition. Some are attracted to the upside but not willing to handle the problems. That is a recipe for losing money. But for the right person, business ownership can be one of the most powerful ways to replace a paycheck because it allows you to participate directly in profit creation, not just receive interest or dividends. The key is honesty. Are you willing to work? Do you understand the industry? Can you handle uncertainty? Can you read the numbers? Can you manage people? Can you survive the mistakes? If the answer is no, then the business may not give you freedom. It may take freedom away. If the answer is yes, and you approach it with discipline, business ownership can be a major income-producing asset. The final category is peer-to-peer lending or private credit. This is where you lend money not to the government, but to another person or business. That borrower may use the money for a property, a car, a personal loan, a business need, or another purpose. In exchange, they pay you interest. The appeal is obvious. Private loans can sometimes pay higher interest rates than government bonds or traditional fixed income investments. You may see opportunities that pay 5%, 10%, 15%, or even higher. But again, higher return usually means higher risk. The borrower may not pay you back. That is the basic risk. This is why collateral matters. If you lend money and the borrower defaults, what can you recover? Is the loan secured by real estate? Is there a lien? Is the collateral worth enough? Who is first in line? What happens if the market value falls? What legal process do you need to enforce your claim? These questions matter more than the stated interest rate. A 20% loan can be a terrible investment if the borrower cannot repay and the collateral is weak. A lower yielding loan can be better if the borrower is strong, the collateral is real, and the structure protects you. This is why private credit is not something to treat casually. It can be a useful income asset, but it requires due diligence. It requires understanding the borrower, the security, the documents, the platform, the legal rights, and the recovery process. Some people use online peer-to-peer lending platforms. Some lend through private networks. Some participate in hard money lending tied to real estate. In the source, the speaker made clear that this was not an area of personal experience, but one that some people use to create income from capital. That honesty matters. When you do not understand something, you should say so. The world is full of people who pretend expertise because they want confidence. But confidence without understanding is dangerous. In investing, humility is a risk management tool, so if private credit is considered, it should be approached slowly, with education, documentation, and a clear view of what happens if the borrower fails. Now, after looking at these 5 assets, the most important thing is not which one sounds best. The important thing is understanding the system they create together. Treasuries can provide simple income with relatively low credit risk but limited growth. Dividend ETFs can provide diversified business income but still expose you to market risk. REITs can provide real estate income through securities but require understanding the underlying assets and interest rate sensitivity. Direct real estate can provide cash flow, hard assets, leverage potential, and tax benefits, but it requires work and correct numbers. Businesses can create powerful profits but demand skill, energy management, and risk tolerance. Private credit can generate higher income but requires strong underwriting and protection against default. Each one has strengths, each one has weaknesses. The wrong way to use them is to chase yield. The right way is to match the asset to the job. If you need liquidity, you do not put all your money into a property that takes months to sell. If you need stability, you do not depend entirely on a risky borrower. If you need growth, you do not hold only short-term treasuries. If you want passivity, you do not buy a business that needs you there every day. This is how intelligent portfolio construction works. You begin with your goal. If your goal is to replace a paycheck, you calculate the income you need. Then you look at the capital required. Then you look at the risks. Then you build slowly. Most people want the final answer without doing the math. They want someone to say, buy this and never work again. That is not how reality works. The path to replacing income is a sequence of decisions made over time. You earn money, you spend less than you earn, you save the difference, you put that capital into assets. Those assets produce income. You reinvest part of the income. Over time, the income grows. Eventually, if the system works and your spending is controlled, the asset income can cover the life you want. That is the loop. It is not glamorous, but it is powerful. It also requires sacrifice. If a person spends everything they earn, no income asset will save them. If a person invests without learning, no asset class will protect them. If a person takes too much risk because they are impatient, the desire for freedom can lead to dependence. The paradox is that the people most likely to gain financial freedom are often the people willing to move slowly. They do not need every opportunity. They do not need the highest yield. They do not need to impress anyone. They need assets they understand, risks they can survive, and a process they can repeat. That is the real framework. For someone beginning, the simplest step may be learning how interest income works through treasuries. That teaches the relationship between capital and yield. The next step may be learning how dividend ETFs work. That teaches ownership, diversification, and the difference between yield and business quality. Then a person may study REITs or real estate. That teaches operating income, expenses, taxes, maintenance, and the importance of buying at the right price. Then, if they have the temperament, they may study business ownership. That teaches profit, systems, management, and the difference between working for a paycheck and owning the source of paychecks. Finally, if they have the skill and caution, they may study private credit. That teaches underwriting, collateral, and the reality that lending money is easy while getting it back is the part that matters. That progression matters because each layer builds a mental model. And mental models are what protect you. A person who understands only the yield will eventually be harmed by the risk behind the yield. A person who understands the machine can make better decisions. This is why education is part of the investment itself. The return does not come only from the asset, it comes from the quality of the decisions you make about the asset. And I want to make one point very clear: replacing a paycheck is not the same as becoming rich. It is possible to have a high net worth and still be dependent on work because the assets do not produce usable income. It is also possible to have a modest but well-designed income system that creates more freedom than a much larger pile of assets that cannot be accessed or understood. Freedom is not measured only by net worth. Freedom is measured by the relationship between your expenses and your reliable income. If your expenses are high, your freedom number is high. If your expenses are disciplined, your freedom number is lower. This is why spending is part of investing. A dollar you do not need to spend is a dollar of income you do not need to produce. That is another system principle. People focus on making more, but reducing unnecessary obligations can be just as powerful. If you need $80,000 a year to maintain your life, then that is the income target. If you can live well on $60,000, the target changes. If you carry debt, large fixed expenses, and lifestyle inflation, the target becomes harder. If you reduce those burdens, the same assets give you more freedom. The asset side and the expense side are connected. Most people treat them separately. They are not separate. The goal is to build an economic machine around your life that is resilient. Resilient means it can handle bad tenants, lower dividends, falling interest rates, business slowdowns, repairs, inflation, taxes, and personal mistakes. If your plan only works in perfect conditions, it is not a plan, it is a hope. And hope is not a strategy. A real income plan assumes things will go wrong. It assumes a tenant will leave. It assumes rates will fall. It assumes a dividend may be cut. It assumes a borrower may default. It assumes a business may have a bad quarter. It assumes you may need cash at the wrong time. Then it asks, can I still survive? That is how I would think about these 5 assets. Not as a promise, not as a magic list, as a menu of income machines with different mechanics. The disciplined person studies them, chooses deliberately, diversifies wisely, and builds over time. The undisciplined person sees a yield, gets excited, and calls it freedom. Those are very different paths. If you are serious about replacing a paycheck, do not begin by asking which asset pays the most. Begin by asking which asset you understand well enough to own through difficulty, because the difficulty will come. Treasury yields will change, dividend funds will fall, real estate will need repairs, businesses will disappoint you, borrowers will miss payments. The issue is not whether problems appear, they always do. The issue is whether your system is strong enough to absorb them. That is why I believe the most important asset is not treasuries, ETFs, real estate, business ownership, or private credit. The most important asset is judgment. Judgment tells you when a yield is too good to be safe. Judgment tells you when a real estate deal is not worth the trouble. Judgment tells you when a business is really just a job in disguise. Judgment tells you when a borrower is paying a high rate because the risk is too high. Judgment tells you when your desire to quit working is pushing you into a decision that could make you less free. That is the deeper lesson. Investment income is not created by owning random assets. It is created by owning assets that fit together in a coherent system. A system has inputs and outputs. The input is your earned income, savings, time, knowledge, and discipline. The output is cash flow, resilience, optionality, and eventually freedom. If the input is weak, the output will be weak. If the system is designed badly, the output will fail under stress. If the system is designed well, the income becomes less dependent on your daily labor. That is the real goal. Not to never work again, because work itself is bad. Work can be meaningful, work can build skill, work can give purpose. The goal is to not be forced to work because your bills will not wait. There is a big difference between choosing to work and needing to work. Income assets create that difference, but they do it slowly, they do it through capital, they do it through discipline, they do it through risk management. So when I hear people say they want to replace their paycheck, I think the first step is to become very precise. How much income do you need? How much capital do you have? How much can you invest each year? How much volatility can you tolerate? How much work are you willing to do? How much tax complexity can you handle? How much liquidity do you need? Which risks can you survive, and which risks could ruin you? These questions are not obstacles, they are the map. And once you answer them, the 5 assets become easier to understand. Treasuries may serve as the base layer. Dividend ETFs may serve as the diversified income layer. REITs or real estate may serve as the property income layer. Business ownership may serve as the profit engine. Private credit may serve as a specialized lending layer for those who understand the risk, but no one needs to use all of them. No one should force themselves into an asset they do not understand just because someone online listed it. The best asset for you is the one that fits your goals, your skills, your capital, your temperament, and your risk capacity. That is the principle. And if you remember nothing else, remember this: a paycheck is a stream that depends on your labor, an income. Producing asset is a stream that depends on capital, structure, and risk. To replace the first with the second, you do not need hype. You need a system, you need patience, you need to understand what you own, and you need to build it before you need it. Because the best time to create investment income is not the day you are desperate to quit your job. It is years before, when you still have earned income, when you still have time, when mistakes are survivable, and when you can let compounding and learning work together. That is how people quietly become free. Not by guessing, not by gambling, not by chasing the asset with the biggest advertised yield. They become free by turning wages into capital, capital into assets, assets into income, and income into optionality. That is the cycle. And once you understand that cycle, you stop thinking like someone who only earns a paycheck. You begin thinking like someone who owns the machines that create paychecks.